Assalamualaikum and hello everyone. Welcome to our Quarter 2 2024 Market Outlook. I'm Fartini and I'm your moderator for the session today. I'm delighted to introduce our speakers, and they are Mr. Christopher Liao, CEO and CIO of Principal Singapore, and Mr. Jesse Liu, CIO Fixed Income of Principal Southeast Asia. And with that, let's start our conversation. Now, the first quarter of 2024 has just concluded, and we've observed notable developments, including the ongoing moderation of inflation and potential changes in the policy pathway. Developed markets have shown resilience despite ongoing uncertainties. The US economy remains strong, Europe barely avoided recession, and China signals a recovery. In Asia, Taiwan, Korea, and India have emerged as strong winners. So on that note, Chris, can you share your thoughts regarding the equity market in the first quarter?
It was a quarter of dispersion, with markets like Taiwan and Korea doing very well on the back of higher sales of semiconductor. Essentially, it was a recovery of the market. And markets like Vietnam, Philippines, and Malaysia, they also did reasonably well. Notable is that markets like Philippines, for example, they had a high inflation period last year, and inflation essentially came off as we went through the end of quarter 4 of 2023, and that helped markets to also bump up a little in the first quarter.
Okay, thank you for your perspective, Chris. Now, Jesse, let's hear your take on the fixed income market in the first quarter of this year.
Okay, thank you. When we look into the first quarter, really we are coming out of November, December of 2023, whereby the bond markets were really bullish at that time, and largely because there was a lot more expectations in terms of interest rate cuts over in the US. When we reached the new year, January and February, we saw some dialing back in terms of performance, largely because that expectations reversed out when some of the data prints coming from the US were stronger than market expected. So when we look into the US dollar market and the global aggregate market, they were still chartering on a quarter-to-date basis negative numbers. But if you contrast it to local currency markets, like what we have here in ASEAN, specifically like Malaysia, it is still positive, more than 1%. And that is because when we look at a monetary policy standpoint, Malaysia is relatively more stable. Markets were not expecting any big changes, so in terms of taking position in those markets, there were more convictions, say for example into long duration positions.
Okay, thank you for that, Jesse. Now, Chris, considering the recent talks and rising interest in growth assets like small cap and technology stocks, do you see this increased interest as justifiable? And does this segment still offer a reasonable risk-reward profile, considering the significant rally in price since second half of last year?
Yes, I would say that in terms of looking for growth-related names, technology certainly stands out. And one of the reasons for that is because of certain trends that we see happening. For example, we have the proliferation today of artificial intelligence, and throughout the masses, we have applications such as ChatGPT being used more widely among not only people but also working the corporates, right? They're also using AI in order to improve productivity, and continuing on certain other trends that we have seen before this, which is the advent of more powerful smartphones, the need for more data-intensive capacity to handle the amount of workload that is being put onto, for example, the cloud. All this is leading to a lot of the major trends that are underpinning what we call broadly technology, right? So I think these trends are probably enduring, and of course, given how hard the sector has rallied, we certainly need to be conscious of not taking a broad brush approach of buying every technology name. We need to be careful looking at bottom-up fundamentals as well as whether the valuations do indeed justify the growth prospects of these companies.
Okay. Thank you, Chris. So, Jesse, we've witnessed some volatility in bond yield recently, particularly in response to the recent US data, which showed a slight inflation uptick and resilience job numbers, and the US Fed's comments indicating that rate cuts are unlikely to happen sooner than expected. What are your thoughts, Jesse, on future policy rates?
So our base case is really that we think that the US would still consider policy rate cuts probably in the second half of the year, largely because if you look into the inflation data, like you pointed out just now, it has been surprising, but it's not surprising too much on the upside. If we look into the trend is still one of a declining one, and it's getting closer and closer to where the Fed really is more comfortable to look at cutting rates. So in that sense, I think I agree with the Fed in terms of there's no rush for them to cut rates, but I think that because interest rates are at 5.25 to 5.5%, it is actually quite restrictive at this point in time. So taking some adjustment downwards is not something that's unusual, in my opinion. Where I think it can create a little bit more volatility for the US market is that US data can be a little bit more volatile as compared to, for example, economies over in Malaysia or in Thailand and Indonesia. So that is something that I think investors should be a little bit more cautious about when taking, for example, more interest rate risk for their portfolios when it comes to US dollar bond investments.
Appreciate your perspective on that. Now, let's discuss the Asia-Pacific region. There is still a lot of anticipation that Asia may see a potential rebound, considering the market hit its lowest point in recent years, and the forward earnings suggest upside. China's National People's Congress meeting seems to suggest more supportive policies are underway as the government reiterates a pro-growth stance. So, Chris, what's your insights on this situation, and can we expect a significant upswing in the near future?
So let me first set the stage about the importance of China to Asia. Yes, indeed, China's outlook is important for Asia, but Asia is not China, right? So it's very important to look at the drivers for returns, for example, in Asia in the last few years, and really it has not been China or Hong Kong and China if you put them together. I think that investors in Asia need to not only consider the prospects of China in the equation. As important China is, but it's not everything. I would say that the prospects of other parts of Asia are very strong. For example, India, Korea, Taiwan, which have done very well, the latter two mainly because of the technology-heavy constituents in their benchmark, and the fact that they have world-class technology companies in the benchmark. And also looking at the broader Asia, including Southeast Asia, which have a lot of benefits going for them, such as demographics, such as generally good fiscal balances, generally strong or stable governments today. So I would say that putting aside the outlook for China for just a moment, I would say that Asia's returns are also strong, driven by these Asia ex-China constituents. For China specifically, yes, you're right, the NPC has talked about a GDP growth target that is relatively strong. I think this year they're looking at something like 5%. I would say that they would need, at the moment, to do a little bit more than what they have done in terms of policy stimulus, right? So I would say policy momentum in China in the first quarter has been perhaps a little bit slower than what I had anticipated earlier. I think they need to do more, and I expect them to do more come the second quarter and into the second half. And in my opinion, it is not also just about spending money. So it's not just about monetary stimulus or fiscal stimulus for China. What's important for China is to get policy coordination right. So policy coordination among all the different government agencies needs to be implemented in a cohesive and consistent and sustainable manner, so that the private companies in China can have the confidence to invest. What is lacking now, one of the things that is lacking now in China is that private sector confidence is weak. And for that to be addressed, it is not just about money, right? So we need policy, and we gather, although it's not been announced just yet, that the government will come out with certain policies related to the private sector to ensure that there is a level playing field between the state-owned enterprises and the private sector.
I believe, audience, you'll find that really, really helpful, and that will help you to make more informed decision. Now, thank you, Chris. Jessie, turning to the Southeast Asia bond market, are you anticipating any major ratings shift in the regional and local market? Additionally, how do you perceive the context of issuance and trading volume evolving in the Malaysian bond market in the near term?
Right. So when we talk about Malaysian on a technical aspect of it, what we are seeing today really is there's a lot of cash that is actually chasing not as much bonds. And there are a few reasons why it is, but one of which we believe is that the buyers, the natural buyers of, let's say, Malaysian securities, like the pension funds and whatnot, I think it has picked up this year, and it has caused a lot more demand into bonds, especially government bonds. But specifically for investors, the likes of us, any asset managers, we are also looking into investing into a lot of corporate bonds, which there are not as much issuance coming in. So when you look into this market, you will see that there's more demand chasing supply, and therefore the difference between corporate bond yields and government bond yields, they actually start to narrow. So that's a sign in terms of demand, and I think this demand is now a little bit broad. When you have an environment whereby the policy rates are steady, and when people are more comfortable taking not only duration risks but also credit risk, you will see then it starts to move that market in terms of pricing. That spread I was talking about is narrow. So if you look into the second quarter, for example, we don't think there's going to be a lot of changes to policy rates. If there's any changes, maybe one is talking about a rate cut over in Thailand, but otherwise I think most of the other central banks are talking about keeping their policies at this point. When you have such an environment, everything is a little bit more steady. I think investors' demand for bonds will continue to be very robust in second quarter.
Okay. As we wrap up today's discussion, let's get some advice for our clients regarding the asset allocation for 2024. Chris, let's begin with you, and then we'll have Jessie provide his thoughts.
Sure. So our advice is to have a balanced view between both equities and fixed income. And within equities, the preference is to have a bias towards income-generating equities, i.e. a portfolio with a relatively good dividend yield, and one where there is a quality growth aspect. So what I mean by quality growth is that we want to own a portfolio of companies whereby the growth is not necessarily at the extreme high end, nor at the extreme low end, but one where growth is generated on a more sustainable basis. Right? So if one were to look for a more diversified portfolio within equities, one can also add in perhaps a mix of smaller cap names if you want growth, or more so-called higher growth sectors, such as technology. But say, for example, within the smaller cap names, one could maybe look at Malaysian small caps as one idea, but I would limit it to a smaller part of one's portfolio because these are generally higher risk, more volatile segments, but they do offer some exposure to the potential of capital gain over the long term.
And Jesse, can we have your perspective on this?
Right. So in terms of ASEAN, it's fairly straightforward, like I mentioned earlier. I think local currency strategies, I think we can afford to be longer duration as compared to the US dollar ones. And I think because market is so short of corporate bonds, technicals are generally positive. So I would say for local currency, duration-wise, we will be longer than a typical dollar bond portfolio, and we probably will try to carry more corporates into the portfolio as much as we can. I think where it can be interesting is the dollar part, whereby, like I mentioned earlier, January and February, you have seen generally weaker US dollar bond markets. And then because of that, you can see value actually coming out of it. But the space that we are covering in Asia, in the global sukuk universe, those can be interesting plays. Why Asia is because Asia has a wider spread as compared to US, and why global sukuk tends to have a natural lower duration as compared to the market. So if I were to point out to global sukuk, if we are in an environment whereby, let's say, US data can still be volatile, I think taking duration position needs to be a little bit more pragmatic. There are times where you can take duration, there are times that you want to be a little bit more defensive. In that case, if you look at the global sukuk, not only you have higher spreads, but also you have shorter duration, and the yield curve is inverted anyway, right? So in that sense, you would still be rewarded with a high yield kind of positioning in the global sukuk, and at the same time, the lower duration should limit the amount of volatility in the global sukuk space.
Okay.
Yep.
On that note, thank you so much, gentlemen, for your perspectives today. And to everyone watching, we hope that this quarter's Market Outlook has provided you some valuable insights and information to help you manage your long-term investment goals. Thank you, everyone, for watching. Till next time, stay safe and be well.